Not to be surprised, I'm going to start our conversation with AI. But I want to tackle it from two different perspectives, because you come at investing from two different ways, two different styles. So you're a quantitative investor. Data science is always critical to how you make your investment decisions. You hired your first PhD, Leda, in AI back in 2008.
That's right.
To help build out your strategies. You now, I read, said you needed a team of, quote, feature engineers. What is that?
Right. So if you think about the availability of data and the ability of AI and machine learning to turn any bit of information into useful data, whether it's imagery, whether it's text, sound, unformatted text. So back in the day, a new data set would be a new time series of prices, time series of volumes traded, but it was a time series. Nowadays, a data set is anything. A collection of words, a collection of sounds, a collection of images, consumer data. So while a time series, everybody knows how to look at a time series. They plot a chart, and the horizontal axis is time. These more amorphous data sets, they have to be explored. What are the features? What are the variables that I'm looking at in this data set? And so there is a discipline now that we call feature engineering. Look at this data set. What are the horizontal axes that you're going to inspect the data on? What are the relevant parameters to characterize the data set? And so we do have a research area within our company that is traditionally research for us is alpha making. So in the last few years, we actually formed a research team that was all about data. They're not alpha makers. They're just people that treat and interpret and select the data.
But less than 5 years ago, this group was alpha makers.
Correct.
And that just shows you how quickly this is changing.
Yeah, that's right. That's right. Yeah.
I read where you said, quote, nowadays the data is so much greater in volume and so specific that it no longer makes sense for it to be in their domain. Speaking of what was in the domain of your investment staff has now morphed to these feature engineers.
Yes, that's right. So there is a research activity that is research. It is creative, it is innovative, it requires mathematical skills, but it preempts the alpha making. It's about understanding the data and exposing. Like they talk about what elements have you exposed of this data set? You know, so you see, you would never ask that question with a time series, right? A time series of prices, a series of prices versus time. You know, there's time and there are prices, and off you go. But as I say, the new world, the data is such a broad concept now that data sets need a bit of work before they can be used for alpha making.
So, Afsana, if I called you a more traditional investor, is that okay?
Absolutely.
Oh, but these guys also use their data really well.
Sure.
Yeah.
How do you see the AI story playing out from your lens?
So at Rock Creek, we do two things. One is we invest in early stage companies, particularly in energy innovation, and then we invest as like the outsourced chief investment officer across lots of funds. So we have two sets of data sets. We were early investors in Y Combinator when Sam Altman was there and started OpenAI, so we were fortunate in that way. But since we started Rock Creek, we have had about a third of the team when we started Rock Creek was computer scientists and quant people. And what Leda said is super important because we've used this data in a huge way, and today, the way we can, with AI, basically be so much more efficient with ingesting the data, making it more structured, making it so that we can make better decisions on our investments. That has changed dramatically in the last 12 months, even more in the last 6 months. So
one third of your staff,
absolutely,
computer scientists.
Today it's changed because maybe about a quarter is, and we just actually launched a group called Serious Innovation Lab, literally on November 1, that has information on several thousand funds and is looking at what signals you can pick from that, but also you can do your first due diligence. All your documents, everything is in one filing cabinet.
Yeah.
So it makes our work very different than it was 2 years ago.
Are you
even in
I'm
the
telling you,
traditional realm.
Scott, everybody's a quant now. Everybody's a quant.
So true. That is so true.
Because the world, I remember the first time I heard the phrase data-driven decision making. And I thought to myself, is there any other kind? And then I thought, wake up, Leda. Of course, there's only the other kind. People make decisions with emotions, not with data.
Is it fair to say that AI in some ways has democratized being a quantitative investor?
Absolutely, absolutely.
Because we have access to data in ways and we can have it processed in ways that we never had before, and we can use it to our advantage as we're trying to generate alpha.
Exactly, and AI will help you, even if you're not necessarily that familiar with analysis. You've got to be a little bit careful, right? So like I treat the AI tools a bit like keen interns, you know, like they're a bit keen, so you've got to tell them exactly what bit of analysis you want them to do for you and check their numbers a bit. But in general, people with much less mathematical training can use the tools to analyze data and to interpret data more efficiently.
Do you ladies think we'll get to a point, and maybe in the near future, where you'll use learning algorithms to actually pick investments? Will we get to that point? Afsana, how do you see that?
I think today, the way we see it is you will be humans using the algorithms to make better decisions versus the algorithm, making a decision. Things could change over time, but at this point, what we can do, particularly in less quantitative areas, you do need the human. And without that, you can't really do your work. Where you don't need us, and the AI can do a much better job, is what we talked about: getting the data, cleaning the data, making it in a format. We used to have 20, 30 people just to do that. You don't need that skill. You need very different skills, but that decision making and judgment, I don't think that's going away.
Leda, do you agree?
Look, mathematically, the big problem is that financial data is actually quite sparse. Right? And quite sparse, and there's a lot of randomness in it. And those two things make it very hard. It's not your traditional deterministic problem. Like if you think about the self-driven car, what is random when you get into a car and you ask a car to take you from here to JFK? What is random? You know the roads, you've mapped them. And even if you haven't mapped them, if they've changed a little bit, the car has cameras. And so that's mostly a deterministic problem. The financial data contains a lot of randomness, and that makes the decision making a bit difficult to automate, for sure.
So Afsana, if I said, okay, let's just take AI completely out of the story altogether, where are the best growth opportunities in the markets, do you think?
When we look at sort of the macro top-down right now, the world is changing so fast. In 2 or 3 ways. We talked in the earlier panels about tariffs, we talked about macro events, geopolitical issues. And I think if you follow that line, obviously the big question, I think, is US interest rates and US currency. Because basically the last 10 years, it was one direction, all investors going into US. And you didn't even think about currency. So there's a big switch in 2025. It will be very interesting to see in 2026 if that continues, because the fact that the dollar has weakened and may continue to weaken given the extra debt that we will need, particularly if, depending on how the Supreme Court rules on the tariffs, we might have even bigger issues. So if the government is putting out more debt, we have to think about somebody buying that debt. On that front, we are starting to do currency hedging, at least. If you're investing in Europe or Asia, you're not just staying in US dollar currency. You are hedging. You're not hedging, you're staying in the local currency. So I think that's one big thing that people are thinking about, because that can generate 10% returns if you had done that last year this time. The second thing is, obviously the big themes are, whether we like it or not, things around defense. And again, you don't have to be doing any offensive things, but in terms of protecting yourself, particularly in Europe. If you look at that, I think those trends will continue. We talked about AI, and not AI necessarily the big stocks that have driven the economy, 90% of the growth in the economy and the markets the last year. but really things around AI, the way we're using the applications, how it will affect consumers, how it will affect second level, third level things. So I think those are the kinds of companies you want to look at. And I'm still very bullish on energy innovation, because for all the things we talk about, you need energy innovation.
When we look at international stocks, I didn't realize how dramatic the numbers actually are. International stocks are outperforming the S&P 500 by the widest margin in 16 years.
Yes.
Record highs, France, Spain, London, Ireland. I saw just in fact today, emerging markets are outperforming their developed peers by more than 2 standard deviations. For all of the reasons that you said, and you see that continuing into 2026?
Emerging markets are very interesting, because if we had talked on Liberation Day, we would have thought they would get killed, right? Mm-hmm. And exactly the opposite has happened, because they've adjusted well, because they had good central bank policies, et cetera, et cetera. I think that will continue. Some of it will depend on how the US dollar does also. But on emerging markets, I think there is differentiation, as you said, going into next year. Places like Korea or Taiwan, depending again on geopolitics, could continue to do well. India, which if you look at 3-year, 5-year, 10-year, has done far better alongside Taiwan than the rest of the emerging markets. I think we'll come out of the slump, particularly if tariffs change on India, and that will sort of come back. Emerging markets as an asset class, though, in the last 20 years has not performed, despite the last year. So the big question is, why will emerging markets do better the next 3 years or the next 5 years or the next 10 years if during this huge growth, particularly with China, you either lost money or you made just a couple of percentages in emerging market? That question mark still is there.
We have a couple of questions, I'm told, from the audience. David?
Yeah, this is a good one. Going back to Leda, what you were saying, I think half joking about how everybody's a quant investor now. But the question is, in a world where everyone is a quant investor because of AI, or I guess AI enables people to use quantitative methods more easily, how can you maintain an edge in investing?
Look, it's being at the forefront of everything that gets done, right? Apart from anything, Afsana and I were talking just before the panel about the barriers to entry nowadays, the cost of data, dealing with all these, again, when I say any bit of information can be a relevant data set, but typically these data sets, these exotic data sets, they're marketed by small companies that are really spread out. And so dealing with these vendors, onboarding this data, cleaning it up, all of these activities are complicated, right? When I say everybody's a quant, I mean even in your day-to-day life and decision making nowadays, the things that we look at. You look at reviews, you choose a restaurant, you take an Uber. So all of these activities, they're very information, they're data driven, right? But the activity of collecting and treating financial data and designing alpha constructs on that data is still quite a specialized one.
Do you have another question? No? I'd love to ask you, Leda, in a highly concentrated market like we have really been in for the several months, year, it feels like, how does that impact a quantitative investor when you have performance? You have outperformance from such a small group of stocks. Mm-hmm.
Look, so the answer is a bit contrarian in some ways, because back in the old days, there were only so many investment styles that were available to quant investors, right? So if you're going to be a quant trader, there's a few things you do. Oh, you do this type of macro, you do this. Well, that has changed so much. I mean, just about every product, every instrument can be traded electronically. You can lift data electronically for all sorts of things. And so when you say to me how have the quant styles performed in the current environment, then my answer has to be, well, we've got a whole palette of styles, and some of them have done well, some of them have not. So I can't easily say, well, it's been good for quants or bad for quants, because you've got quants doing equity market neutral, you've got quants doing volatility arbitrage, you've got quants doing macro trend following, macro non-trend, and all of these things are performing differently. I would say one interesting highlight for 2025 has been the really strong performance of a quant equity market neutral, which is the strategy where you really try to milk the relative value opportunities between stocks. So that style had suffered for a few years, for a long period, and that style is really firmly back now, indicating perhaps that, you know, all of this innovation and AI, and also cost of capital going up a little bit, is really rewarding the good CEO and differences between companies. So, for example, what Afsaneh was saying, we explore in some of the alphas that we use for our equity market neutral program, we explore regional revenue differences precisely because of the hedging element. And you kind of know different companies implement their hedging differently. And because so many companies are global in revenue now, this makes a difference to their performance. So I would say, you know, there is, in my mind, a quant style, but rather the quant implementation of the various styles. And the highlight has been equity market neutral, really.
I was going to completely agree with Leda, because equity market neutral not only has been interesting recently, but I think looking into 2026 will be even more interesting with the trends we're seeing.
Because I asked a question about concentrated market, I guess it leads me to growth versus value. How do you see this playing out into the new year?
I think the trends that we're seeing, you're going to see two formats. One is, I think overall in the market, value probably will have a better time than it had this year, because this year was all about momentum and, you know, the Magnificent Seven and people around that. So I think that will definitely be an interesting place to look. But on growth, maybe we have to look at smaller companies that are growing, because growth, when we talk about growth, is about the largest stocks right now. But if we look at growth within small companies, and we do that in private and public, obviously, I think that will be super interesting. But value is definitely the place to be, and including in Europe and Asia.
And perhaps picking up on what Mary said in the panel before, with a bit of a lagged growth story outside the U.S., right? Because you know, it's our experience as well. You know, nowhere is the adoption of AI moving as fast as it is in the U.S. That is clear, you know. And so, but they'll get there. The rest of the world will get there. But maybe a bit of a lag there on the other regions.
What's your outlook, Afsaneh, for hedge fund performance? We're in a different rate environment, obviously. Hedge funds have tended to outperform when rates are rising. It tends to be much more volatile. Now rates seem to be coming down, and we think the Fed's going to continue to cut interest rates in the months ahead. Though December seems like 50-50 at best, maybe less, and that's part of the reason why the market was maybe reacting the way it was today. But what about the outlook, and how will that impact performance?
So I think, as you said, interest rates are expected to go down. However, you know, what will happen, whether it's this month or not this month, makes all the impact on markets, as we saw today. So given that, I think, again, that's where hedge funds can do well. It's when there's those kinds of uncertainty and the potential for making the kind of trades that Leda was talking about. The big, I think, people that will gain in this kind of environment will be some of the quant strategies, particularly compared to sort of long-short hedge funds. So when we say hedge funds, again, you know, we're talking about macro hedge funds, we're talking about long-short, we're talking about the quant strategies that vary, as you very nicely described later, and then many other strategies that we all invest in, including credit, etc. Each of them will be impacted differently. In credit, there will be very interesting strategies, I think, and in quant strategies, there'll be interesting places to look at. But long-short may not be ideal.
We have about a minute left, and I'll come to you just 1 second, I promise. I'd be remiss if I didn't ask you, ladies, because I was thinking about it, and I was looking at some research, and I wanted to talk to you about the growth in female-owned funds, and whether you think we're going to see higher growth if sovereign wealth funds and pension funds are allocating more capital towards hedge funds, if it's going to be beneficial for female-owned funds, traditionally smaller or more mid-size. I'd love to have both of your views on that. Lady, why don't you go first?
Yeah, we were just talking about it before yeah, just a couple minutes ago. We suspect that if anything, it's more difficult now, simply because it's more difficult to start a hedge fund. The barriers to entry are so high. Huh? The cost of data, the cost of complying with the regulatory environment. I mean, how much do we spend on cybersecurity in our firm? Gosh, you know. And so because of the barriers to entry being so high, you're going to see possibly more consolidation and fewer startups. And therefore, that route that, you know, that welcomes, you know, the minorities or the women or whatever is a little more restricted now. So
completely agree with what we were just saying before you started talking to you, but I think the one area of hope is venture, where you can start small, where you can start with a 50 million or 100 million, 200 million fund size. So that is where you might see more opportunities and more women in founding companies. I think we're seeing more of that. Maybe 10% of companies that were founded last year were women founded. So we're seeing it in those areas. But in hedge funds, size. And the people you referred to, sovereign funds, pension funds, they have a prejudice for large. The interesting thing is when I was at the World Bank and we started investing in hedge funds, we always looked for new talent. I think a lot of investors are very traditional. They're looking at the largest. So for you know, women or other people starting, I think it's a difficult environment unless you're established like Leda.
Yeah.
Let's finish with a question from the audience. Yes, sir.
Yeah, I want to ask a question about debt in relation to equity. Yesterday I was at an event and I asked a question of an international hedge fund manager because he was talking about the significant amount of debt, deficit financing that is occurring on behalf of governments. Obviously, you know our government's something 37 trillion in the whole deficit-wise. So I said, what's the return on investment on that 37 trillion for every dollar spent internationally? He said, you're losing 50 cents. What impact are we getting on deficit spending relative to equity markets going forward? Because that's got to have some effect somewhere eventually.
Afsan?
If the government is taking money out of the economy to pay back its debt, you will have, you know, that's going to impact the consumers, and you know what that means for the markets, because a lot of the hype in the markets has been with consumers still doing okay. If for whatever reason, including what you described, the consumer gets hurt or has less resources to spend, you're going to have a major impact on equity markets. That's the big risk right now.
Consumer spends 70%, is 70% of GDP. So that's what I'm looking at.
Exactly.
Thank you, ladies, so very much.
Thank you.
Leda Braga, Afsana Betzlas.